Let's talk about the moving averages because those charts that I showed you had nothing on it. I'm just showing you the different time frames. Now, let's superimpose the proper moving averages. These are the only indicators I use, people. I am not an indicator-based trader. I do not like my charts looking like a bowl of spaghetti. I don't need things to indicate about the truth. I just need the truth. You see, for me, traders, the item is the truth. The item I'm trading is the truth. And when I use an indicator that is indicating something about the truth, I remove myself from the truth. So the thing I'm trading is the truth. There's this indicator that's telling me something about the truth. I don't need a lot of things to tell me something about what I'm trading. So I believe there are a lot of traders who get distracted with a lot of indicators. So the most important thing is the item that you're trading. And an indicator makes you look away from the item that you're trading to the indicator itself. And if you've got 3 or 4 things pulling your attention to those, you've lost sight, you've lost the plot. You're looking at this indicator, that indicator, that indicator, that indicator. You've lost the plot. This is the thing that makes you money, not the thing telling you something about the thing, So I've never really been a very indicator heavy trader because I trade the item itself. The item tells me 95% of what I need to know. I don't need a representative of the item. I need the item itself. Now, the only exception for me is moving averages. And so let's talk a little bit about which moving averages I feel are indispensable and how they're to be used. You see, a lot of people don't use moving averages appropriately. And I'm going to teach you my approach to using moving averages appropriately. Moving averages, the only indicators that I use. So guys, there are basically 4, just like there are 4 major time frames, there are 4 moving averages that I rely on. The first 2 are the 200 period moving average. That's the granddaddy of them all. And then there's the 20 period moving average. They're all simple moving averages. Now, if you've fallen in love with some of the more sexy varieties, all right, fine, use them. But I have found no evidence that any of the sexier varieties, exponential, weighted, triangular, none of that does better than simple. And I've been using moving averages virtually my entire trading life. But if you're in love with the sexier ones, fine. It's not that much of a difference. All right, but I use all simple moving averages, 200 period moving average and 20. Now, these moving averages will always be on the chart. I will never remove them. In fact, I do not consider a chart unless it has the 20 and the 200 period moving average on the chart. So these are permanent staples on my chart. The 200 period moving average is the most powerful when it is flat. All right, write that down. The 200 period moving average is the most powerful, is the most effective when it is flat, relatively flat. Doesn't have to be perfectly flat, flat-ish, okay? The 20 period moving average, conversely, is the most powerful when it is trending, up or down. So what do I mean by this? Your 200 will tend to be a concrete floor if your item is above it. If it is below it, it will be a ceiling, a high percentage of the time. If the 200 is slanted, it's still the case, but less so. So it's a little bit less effective when it is slanted. When it is flat, it is in its most powerful position. Now, the 20 period moving average is the most powerful when it is trending. It will tend to be a significant area of support when trending. When the 20 is flat, it will tend to be powerless. Your item will crisscross like it's not even there. But when it is trending, it will be respected a high percentage of the time. So these are very important characteristics to understand about your 2 main moving averages. 200 is most powerful flat, 20 is most powerful trending or slanted, 45-degree angle, more or less. Now, there's this other group of moving averages I call the power trending tools. This is when you have an item that is power trending, to the upside or downside, we bring in the 8-period moving average or the 13-period moving average. And I want to show you examples of when the 8 and the 13 replaces the 20-period moving average in importance. So the 20-period moving average is very important, but there are times when your item is trending so powerfully that you need to bring in a replacement that is shorter and quicker and faster than the 20. That's when we bring in the 8 or the 13. And so if I were to quickly draw that for you, let's say this is the 20-period moving average. Your stock or your item that you're trading starts doing this. So you see how the 20-period moving average here is irrelevant now. And the trend is steeper than the 20. So then I would have to bring in the 8-period moving average, which is more relevant, okay? So during power trends that make the 20 irrelevant, you have to bring in the quicker ones, 8 or 13. And I'm going to show you how to determine whether it's the 8 or 13 that you bring in to replace the 20 during these power trending periods. You have the 20-period moving average overlaid on the chart and the 200-period moving average. I told you when the 200 is flattish in nature, it is the most powerful. You will tend to get power surges off of the flatter the 200, the more powerful the surges off of it will tend to be. And when the 20 is flat, your item will tend to ignore the 20, not respect it very much because the 20 is flat. But when the 20 starts rising, look at the respect. Boing, boing, boing. You see? So the respect is there. Now, there's always a little bit of slippage, but slippage is not breakage. This is another thing that throws a lot of traders. They don't understand that moving averages are areas. They're not lines. It's not like the moving average is a sheet of ice that when you make contact, it cracks. It's not glass. It's like a rubber band that you can lean on. And so some people interpret a lean on the moving average as a break, and that's a mistake. And they get knocked out of a lot of great trades, not understanding that your moving averages are like rubber bands or fences, a fence that you can lean on the fence, but you don't break the fence. You can lean on it, but don't break it. All right. And so if we go back to this chart, you've got your index is leaning. It leans on the moving average, but doesn't break it. It leans on it a little bit, doesn't break it. It leans, doesn't break it. But this is true breakage right there. Boom. And one of the easiest ways to not get caught into this is you got a full bar under your moving average. You see how these bars are not fully under? They're not fully. There's no full bar under. There's no full bar under. But you get your first full bar under right there. Boom. Now you know you're coming out of 3, going into 4. Where? Back to your 200. Back to your 1. Simple but powerful. Simple but powerful. That's a 2-minute chart. Here's a 5-minute chart. All right. Notice how your 20 starts rising and starts being respected. You see it rising? It's starting to be respected with the rise. Okay. When do you know you have topped out 3? When do you know? When there's 1 full bar under. Okay. Same concept. Same concept here. Your 20 is starting to be respected. On the rise a little bit here, all right? When do you know you're truly left 3 into 4? When you get 1 full bar under. There's something else that had just come to mind. I hope you guys are taking notes with some of these things. Don't try to remember it. It never works. Got to take notes. Another thing, a lot of novice traders think that you need to be super early. You need to catch the tippy top. That's wrong. I need to catch the absolute bottom of a move. That's wrong. That is fanciful. That is only works in Disney movies. It's not real life. And you don't want the exact top and you don't want the exact bottom. And when you drop this notion, strangely enough, your accuracy goes up. So like this concept I told you, when do you know you've got the 4? When a red bar is totally under the 20-period moving average. Not the first one. It's usually the second one or the third one. Boom, that's the one a lot of times to know for sure. You understand? So there are a lot of traders who think their whole approach is trying to grab the tippy top of a move or the absolute bottom of the move, and they will forever be frustrated as traders their whole lives doing that. That's not where the accuracy is. Here is a 15-minute chart of the Bovespa. Again, 20-period moving average, 200-period moving average. This is a beautiful event off of your 20-period moving average to the downside. Here's another one. The full bar that's under the 20, that's the one. I teach my traders that when you are trending, you can do color change entries. So you see this green. When does green get taken out? Boom, right there. When does this green get taken out? Boom, right there. These are called color change plays. And I want you to take a look at this period, though. Notice how the trend is so strong that you want a shorter moving average. The 20 is irrelevant here. So you want like the 8. Notice when the 20 is flat, your item ignores it like it's not even there. But it only when it starts to trend do you start to get some respect. Here is the hourly chart. Now look to the left. Notice the flattish nature of the 200. Doesn't have to be perfect. Usually gets strong moves. Notice the move off of the 20. We'll talk more about this shortly. I also want you to be able to utilize your moving averages, not only in terms of them, when are they the strongest? Like the 20 is the strongest when it's trending. It's the strongest when it's trending. And the 200 is the strongest when it's flat. But I also want you to understand the concept of distance with your moving average. So when your item moves from the moving average to away from the moving average, you are likely close to a 3 top. And you see the space? And especially when you have what I call the 3-finger spread. So the three-finger spread is your item is very high above the 20. Your 20 is high above the 200. So you have finger 1, finger 2, finger 3, all spread apart like this, guys. Look. Okay? Boom, boom, boom. Now like this, like that. So when you got all 3 items spread apart and your stock is the highest item, you're ready to fall back, right? Same in reverse too. If the stock is at the bottom, you're ready. You got all 3 items spread apart and the stock is the bottom one, you're ready to move back up. Moving averages are great guides for space. When you get that space, you're ready for a reversal. When they're all together, you're ready for an explosion. So when your moving averages and your item is like this, you're ready for an explosion up or an explosion down. You understand? But when you separate, you're ready for a reversal. Let's take a look again. Now, notice here where all 3 items are close together. Here's here's the Bovespa, here's the 20, and here's the 200, close together. Then they get wide apart. That has to come back in, all right? And you get wide apart again. That has to come back in. And then you get wide apart again. That has to come back in. So the three items can be great indicators of where you are in that cycle I told you. Wide apart, you're at the end of the cycle, the top of the cycle. Together, you're at the beginning of a brand new cycle. And so these are the two most important points, turning points in the market. So the trends between them, tight and narrow, and then wide. You run from tight and narrow, you run to wide. That run is a money-making run, but there are three things that make for the most profitable trading. When you can capture the narrow explosion, then ride the run and know when you got the three fingers spread, it's over. And maybe a play to the reverse side. These three things make for the most profitable market play. Being able to identify when it's tight and narrow and ready for an explosion, riding the move out of the explosion, capturing as much of that move as you can, and then identifying when it's likely over. Take a look once again, realizing that we're tight and narrow, grabbing the explosion out of the tight and narrow, riding this for as long as you can, and being able to identify when you are likely near top. This is the three elements of the most profitable that lead to the most profitability. Three capabilities: identifying the narrow state, grabbing the explosion out of the narrow state, riding the move to the wide state, and identifying the wide state top. Do that, get good at this, and you will live a very, very pleasant trader's life, because that's all of trading in a nutshell. Trending moving averages. Let's look at the trending ones. Remember I told you that when your item is trending so hard that it makes the 20-period moving average irrelevant. What do I mean by irrelevant? It's just too far away to mean anything to us. What is that 20 doing for me except pointing the way? But it's not close enough to give me any guidance. It is here. Here's the explosion off the 20 here. But it's not this trend. I need more guidance on this. The 20 is too far away. It's almost as if the 20 is across the street and I need someone on the same street as my item. So I'm going to get a shorter moving average in here, which is the 8-period moving average, or the 13. Remember? So it's the 8 or 13. How do I know which one it is? Very simple. Listen carefully. You grab your first pullback in your trend, and whichever the first pullback reacted off of, that's the moving average. So I want you to see the first pullback here. Drop, pullback, boom. And it didn't break the 8. So that means that it's the 8-period moving average. If it broke the 8 and went here, it would be the 13. So the 13 is like this. So which one does the first pullback kiss or come close to? That's the moving average we want to do. Now, why is this important? Because the moving average, in addition to us knowing that the 20 and the shorter moving averages give us direction, they also help us with space, narrowness, and space analysis. They also serve as trailing stop mechanisms. So if I'm in this powerful trend here, I should probably stay in as long as it stays within the 8-period moving average. Now, it appears as though it broke, but remember what I told you. A lean against the fence of your moving average is not necessarily a break. So I employ a 2-bar rule with these moving averages. You need a 2-bar break. You need 2 bars to break, not 1 bar. 1 bar is not a break. That's a lean against the fence. It's like a boxer leaning against the ropes, but the ropes don't break. But 2 bars is a full break. Let's take a look. So a 2-bar break would be You see, that's a 1-bar break. If you break the high of this bar, it would be a 2-bar break. You see? So if the next bar broke above, boom, that's your stop out. You need a 2-bar break with the moving averages. So since this is just a 1-bar, that's not a break, that's a lean against the moving average. And you get a 2-bar break here. You got this whole trend. Now we're gonna talk about how you would be in this bar. You would add on the green color change, boom, and you would be out here. If you don't understand it already, you'll understand this very clearly in short order. So here is the 8-period moving average being applied during this trend, see? Because look at the 20, it's irrelevant, it's across the street. It's not walking next to me or next to the Bovespa. That 20-period moving average is across the street. We need it walking side by side. So the 8-period moving average is walking side by side. And here is your 2-bar break right there. This is not a break. That's 1 bar. But remember, tight and narrow is where you get the explosions from, right? What's tight and narrow? 3 items, the Bovespa, the 20, and the 200 come together. 2 of the 3 come together. If you get all 3, it's extra powerful. But anyway, you get this closeness together. Also, flatness. Do you understand, guys? So when your items are close together and they're flat, whoo, the explosions are powerful. All right, take a look. Look at your closeness. You see? Close together and flattish. And look at the explosion. Boom! Now, remember I told you, yes, your ability to make the most money in markets lies in your ability to identify narrow and flatness. Grab the initial explosion out of the narrow flatness. You must ride the whole thing. Don't get shaken off. We're using the 8 for that, right? The 8 helps you ride the whole thing and know when you're probably near the top. The 200 is probably down here somewhere. I'm going over the tools that help you do those 3 things. Are you good at identifying the narrowness? Are you good at grabbing the initial explosion out of the narrowness? Are you good at sitting back and riding the whole move? Are you good at determining I'm near the end because look at the wideness? What else is there in trading? Nothing. Those are the 3 things you need. The best trades of your life comes out of narrow flatness. Those are the best trades in the world. The best trades of your entire career will come out of narrow and flat periods. You'll have to identify the explosion out of, grab that. You want the initial explosion out of flatness and narrowness. And that's not enough, though. Too many traders get that, but get shaken off. You can't get shaken out of the move. You can't cut the move short. You got to maximize that move out, that trend. We're going to use the 8, 13, and 20 to do that. And then I need you to know, you know what? We're nearing the end. Somebody was like, how do you know? How do you know? I know we're nearing the end because of space. 3-finger spread. If I can get you doing these things, these 3 things, well, I guess it's 4 things. Identifying narrowness, grabbing the initial explosion out of the narrowness. That's 2. Riding that trend, milking that cow. Milk it for everything it has. And the 4th thing, being able to identify when you're near the end, before the end. It's powerful. All right, guys, let's go back. Here's another 5-minute. Oh, here's the 13. I wanted to show you this reacted off of the 13, not the 8. Now, I don't think you can go too wrong if you get it wrong. Like it maybe sometimes you realize you should have used the 8 instead of the 13. And the difference is not that great, but I still want you to be able to do it correctly. And you're out here. All right, you missed this last move, that's fine. But look at the left-hand side of the chart, traders. What did I tell you? Your best trades will come from narrow flatness, and I need you to be able to grab the explosion out of the flatness. I need you to not get shaken out. A lot of traders get shaken out here. No, you need 2 bars to be shaken out. You see? This is 1 bar, and then this would be your stop out if you use the 2-bar stop rule. All right? Here's 1 bar, but the next bar does not break. You need 2 to break in a row. So you don't get shaken out here, and you ride this baby, and you're out there.